Hello traders, and welcome to my video on the triple bottom candlestick pattern. So this is a easy to spot candlestick formation on your charts. You don't require any indicators, just price action. So the first thing to do is to look for an area of support. So for example, here, support. For argument's sake, we'll just use this level here, even though I would be counting this. Came pretty close to the area of support, but you want to mark off an area of support that has been hit or almost hit at least 3 times, hence the triple bottom candlestick pattern. There is such thing as the double bottom candlestick pattern, which is when it's hit twice. However, for the purpose of this video, we're going to be looking at the triple bottom candlestick pattern, okay? So I've marked the support there on the chart, and we can see 1, 2, 3, okay? 3 occasions when price hit or almost hit this level of support, thus giving us the triple bottom candlestick pattern, okay? So once we've marked this off on our charts, the question is, what do we need to do next? It's pretty simple. We need to look for the neckline. So what the neckline is the level of resistance within this triple bottom candlestick pattern. And I'm going to mark it as this level here. Okay, some people may mark it there. I'm just looking slightly further back at this level of resistance here. Either way, mark the level of resistance to coincide with your triple 1, 2, 3 bottom candlestick pattern. So now that we've done that, what's the next point? So we need to wait. This is the consolidation zone. That's what we're calling it. And we're going to wait for price to break out in an upwards direction from this zone. Okay, so after the 1, 2, 3 hits, you can see the price starts to move up. And then when we get to the resistance here, there's quite a significant breakout, perhaps because many traders were watching this formation play out. We are on the pound-dollar 1 hour chart. I like to use the higher chart time frames just because I feel the fact that there's more price data included makes signals more reliable. A lot of big players and institutional traders will be watching these chart time frames. It also means less time chart watching and does make, in my opinion, patterns easier to pinpoint. Okay, so what you're looking to do is to enter on the breakout of the resistance following the triple bottom candlestick pattern. And that occurred here, as you can see. Some traders may enter as soon as price crosses above. However, some may want to wait for the candle to close above, as it did here. So if we waited for price to close above, thus confirming the completion of our triple bottom candlestick pattern formation, we could have taken an entry point here, placed a stop loss just below that resistance level, which would have been really reasonable at just 10 pips, which is great for the 1 hour chart time frame. Would protect us in the scenario where we have a fake out and price turns back around, could get taken out, could be taken out early, price could continue upwards, but we'll protect ourselves in case price does fall all the way back down here. I personally wouldn't want to put my stop loss all the way over here and take a almost 100 pip loss on a trade. I'd rather cut my losing trade short and wait to catch a bigger move with a good risk to reward ratio. So not one bad trade is wiping out a consecutive run of winners. Anyway, we've taken the entry here following the triple bottom candlestick pattern, the breakout of the neckline. Let's see what happens. Well, okay. I think it's safe to say that would have been a good trade. Very good trade. How many pips is that? Almost 350. Not bad considering we could have had a 10 pip stop loss. Just goes to show that when this pattern does happen, it's a relatively strong indication. I mean, if you can catch over 300 pips in one move on a 1 hour chart, it's not too bad. You can use any trading instrument. So although this may be a rare formation that occurs, if you're following different currency pairs, stocks, cryptos, you know, plenty of opportunity for them to be found. And yeah, it's easier to catch, in my opinion, 300 pips trading on the higher chart time frames. Imagine taking 10 pip trades on the 5-minute charts. You're going to need 30 winners, 30 winning trades to get 300 pips, which is 30 winning trades in a row. I mean, it's pretty impossible. Not to mention stressful having to take all them trades, the brokers, costs, spreads, commissions, slippage, nightmare. So yeah, I think it's worth mentioning that you don't have to blindly take this pattern by itself. You can use other indicators for confirmation. You can even wait for the breakout just to make sure it's not fake out, and then enter on the pullback. Just as an example, let's put the what indicator should we put on here? Let's put the MACD on there. Okay, so the MACD, basically when it's above 0, we're seeing uptrend, and above the signal line, crossover below the signal line or 0, downtrend. The reason I'm putting the MACD on here is just to show you an example of waiting for the breakout. So the breakout happens here, then waiting for the pullback. You can see on the pullback, the MACD falls below the signal line here. And if we wait patiently until it moves back above, this could be the indication that now would be the time to enter on this particular trend here. Okay, see the MACD crossing back above, which would have been a good entry, still leaving plenty of, well, you would have catched the majority of that move, plenty of juice in the tank for that one there. Okay, I think the good point about this particular entry here is the level of resistance that coincided with it, because price is also, see this resistance level here, price is also breaking out from there, which gives you additional confirmation, not to mention the candlestick patterns that are all showing bullish price action. And you can enter on a MACD crossover as well, as we see there. Crossover, the 0 line to above is again another good entry on a pullback. Don't need indicators, as I said. You can just put another resistance level there and just ignore the MACD completely and just trade on the breakout of that resistance. Many ways you can trade. You can even put a trend line on there, wait for it to hold up. It's holding up strong. Okay, and then we have a breakout up again. That's another way you could have got into that position. What other indicators can we use? We can use a stochastic oscillator. Basically, this is an indicator where you look to enter in and around the oversold zone, which is here for a long trade, a buy trade, with a crossover of the blue and red lines. If the main line crosses the signal line upwards, signals a bullish trend, and vice versa. For a bearish trend, the main line crosses below the red signal line. This zone here is the overbought zone. So if price is here and there's a crossover down, it would suggest the market is going to fall, which it did here. And if price is in the oversold zone and price crosses up, it suggests that the market may rise. Okay. In this instance, that wasn't the case. Price did fall back slightly, so we would have been better off waiting in this instance. And that's why it's good to confirm trades with price action, support, resistance, and additional indicators. I mean, for the stochastics here, what you could have done is waited for some bullish divergence. You can see here we have higher lows, still the crossover, still in the oversold zone. Price had been forming good level of support here. Another reason why we could have maybe considered an entry there. Okay, so you don't necessarily need to get into this pattern on the initial breakout. You can use other indicators or support and resistance to enter as the trend continues. Okay, in terms of exit, you could use a fixed risk to reward ratio, but then more often than not, you're going to miss out. For example, if you said my risk to reward ratio is 3, which means that my take profit is going to be 3 times my stop loss. Okay, well, 10 pips stop loss and you're taken out here. You're happy because at the time you'd be happy because you'd have a winning trade at 30 pips, but in hindsight, unless you're re-entering, you're going to be disappointed that you missed out on 300 plus pips. So what you can do in this instance is once price starts moving away, you can move the stop loss to break even, just so that you don't allow a winning trade to turn into a losing one, and then you can trail your stop loss on the way up with the trend. So once you see levels of support forming, these can be where you move your stop loss. So you enter here, price goes up, up, up. Once price gets around here, you can move your stop loss to break even, and as it continues up, you can move your stop loss just below this level of support, so you've locked in that much profit. Okay, as it continues up, 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 come back and we form another level of support. As price continues on, you can move your stop loss there, up, up, so on and so forth. You would have got maximum potential from this move. You can close part of your position on the way up through the trend. So, close half your position and allow the rest to run. Just depends on your money management. The key thing is, once you're in the trade, try not to let the winning trades turn into losing trades, and try not to exit prematurely, as you can leave a lot on the table. It's a nice feeling to be in a winning position, knowing that even if price turns around, you're still going to bank some more profit. You perhaps closed out some of your trade for profit before then as well. Okay, so that's the triple bottom candlestick pattern. A few ways you can trade it. There's limitless amount of combinations of indicators and price action analysis candlestick patterns that you can use to time your entry, which is why it's important to make sure you're aware of what's going on and combining different elements. Another one we can say would be the ADX indicator. Okay, so basically the ADX, when the green line is above the red line, it suggests we're in a bull market, buying market. And I put the 20 line on the ADX just because when the main line is above, the main line of the ADX is above 20, usually means there's more momentum in a particular move. When it falls below, as it does here, you can see we're in more of a ranging market. So you can look to enter on the cross of the ADX. I personally just use it to filter the trend direction. Basically, when the green's above the red and this is above 20, I know that, okay, we can look for buy trades. As you can see with the breakout there, that the ADX gave us good confirmation. The green is above the red, strong momentum building. And as we saw, it was a good trade to take. Moving along, we have another opportunity here when you can see the ADX was telling us strong momentum upwards, green above the red. This is a point where we could start to look for buy-in signals. As we looked at before, this could be based on the pullback. Other indicators, the stochastic being oversold, it could be waiting for price to breach this resistance level here. It could be price action, candlestick patterns. There's so many ways it can be done. Okay, hopefully you found this video useful. Please like and subscribe for more, and thank you for watching.